In this video, I'm going to walk you through trading rules that not only will help you in your own trading in the future. So you see here that I do have a list of rules, and they're more of just guidelines to help you create those footsteps to become a better and profitable trader. Now, when you look at these and kind of going through them, they might make sense and they might not make sense. It might be common sense, but in reality, when you are the most successful at something, it's because of simplicity, not complexity. And that's the best way to become successful, is keeping things as simple as possible. And you'll see in the service at times that I keep things pretty simple. I might at times use more structured options trades that might be a little confusing, but breaking them all down, they actually benefit and work on a simple and simplistic approach to overall trading. So the first one is really critical in what I think is in being successful, and that's define your risk every trade with a stop and exit before taking the trade. I know that sounds something that many have probably heard of, and myself has even told you before in different training material. This is very critical because unfortunately there's a lot of traders out there or investors that have an IRA or a Roth or a trading account that they really don't take an active approach on. And what they do is they buy, let's say, shares of Apple, and they buy because they just say to themselves, you know, I read this book and it said, hey, I should invest into some company that I know, and I love the iPad mini, and I love the iPod, and I love the touch, and yada yada. Well, that doesn't mean that you have the proper thesis to get into a trade, because it's like an investment. When you vet an investment, and when I was doing private equity and IPOs, we would vet deals. We would look at cash flow. We would vet the deal because we're putting money at it. And the 80% of traders and investors that lose money don't do these simple steps. And yes, it is time consuming. It is tough, but that is the way to get more money, by making more money and utilizing your money as best as possible. So you have to have a bit of a guideline, a bit of approach. You got to say to yourself, okay, I'm going to get into this trade here, and following some of these other rules, this is where my stop is at. But if it actually goes higher, then I'm going to get out here as well. Because a lot of times the trade that you put on, you might have an exit strategy, but the exit strategy is not realistic, which goes all the way down to the reasonable expectations. All these kind of go hand in hand. Also, being able to execute, that is a big one. Execution is very critical. And execution meaning that you have a stop in place, but then the trade doesn't go the way that you planned, so then you kind of call an audible. That's what I refer to it as. You call an audible and you don't execute. Audibles don't work in trading. They only work in football. And that audible is going to take that loss that you anticipated and potentially even make it greater. Now, you could, and there's times where the trade goes the other direction and it works out. But if you track it and keep a trading journal, you will notice and you will find out that those trades actually are far in between. You only remember those because you had paid so much attention to them, but that's just how trading works. You're going to have some that work. They're going to have some that reverse, just to say, okay, wow, I could have kept into it. But that's in hindsight. You never know that. You have to really, really know the road plan, your game plan of when and how to really take and utilize each and every trade possible. So, as I'm talking with you, I'm going to type in a few things here. So the journal is very important. And a journal is to keep yourself accountable. Accountability is critical in success, not only in trading, but in business and in life. If you trade and you track your thoughts towards trading, and if you do it in your own life, you can really find a lot of things and a lot of issues that you might have a problem with, and be able to resolve it with yourself. It's like talking openly with somebody being that you're your therapist, but when you can track your thoughts and keep yourself accountable, you could say, wow, I'm really not executing. I'm not really putting in my stops that I should. And a journal will benefit that. Again, not only do journals benefit trading, but they benefit in everyday business and in life in general. So journal trading is not like some key to success of trading. It's just a vital piece of trading success, because trading is a business, and having to journal your thoughts is just kind of the roadmap of where you are now, what you are doing to get to that place, and being able to say, okay, I need to fix something here because I'm either not successful for these exact reasons, and I need to fix that to create that successful roadmap that I need to be able to continue forward. So the next one, have a small percentage of risk per trade. And what I mean by that is that when we look at define your risk for every trade, we want, and the way that I do in my own trading and teach, and is the most successful way to potentially become profitable over time and continue to be profitable, is having a certain percentage of your portfolio in a trade. So by kind of a default rule of thumb, I know this is a little bit broad here, but we'll look at directional trades. And what I mean by directional trades are trades that we are playing for direction. So if we want the underlying stock or the underlying to go higher, we are looking for prices to go higher. So we're buying an option, or you're buying a stock and you're looking for prices to go higher. Now, if you're looking for it to go lower, we're buying a put or shorting the stock. That's what we're looking at, and that's what I mean by directional trades. Typically, you want to keep this down to about 2%. 2 to 3% is a good average, and the average per trade is going to dictate on your overall account size. Now, when you're in a smaller account, you're going to have to probably risk a little bit more to really make it worth it. And as you increase your account, you can scale down your directional percentage per trade. So 0.5 just means 5% of 10,000, and 0.2% is 25,000. So you can see here, as a $25,000 account, 2% of risk is a $500 per trade. What I mean by that is taking where your defined stop is at and what you're buying that option or stock. That right there is where your stop is going to be in place and how much you're putting at risk. And then you take that and you dictate of how many contracts or how many shares of stock that you're willing to take, dictating that if you hit that stop, that's going to be a $500 loss. If it goes higher, obviously, you want to make your $500 back and plus more. So per trade basis, we're looking at $500 per trade. Now, there's a sliding scale, and a sliding scale for me is those opportunities to, if you feel like you have, or you have a really good setup. So sometimes, you might look at a stock, and we'll look at a few charts in a little bit here, but you'll look at a stock and you say, wow, this is a really good setup. The risk to reward is in my favor. I'm going to go in a little bit heavy here, and not say heavy, but a little bit more than my average. So let's say the average is 2% that you go in. Let's say you say, okay, I'm going to go 3 to 4%. You don't want to go more than 5%, because a 5% clip off your portfolio, depending on a $5,000 account, could be a pretty big slap to the face. So we don't want to risk that as much as we possibly can, because we want to be able to continue to trade. We want to be still in the game. We need to know this is where you get out, and this is kind of the foundation that you have to put together for yourself, because when I said if you're not able to execute, you define your stop, you define where and how many shares you're going to get or how many contracts, and you say this is where my stop is going to be at, and then it comes to that stop and you risked $500 and now it's $550 that the trade has lost. Well, now you're saying, okay, well, I'll just wait for it to get back to 500. Well, options, depending on what option contract that you're in, if it's a shorter term contract, that value is going to continue to decay, and that 550 turns into 600. And then all of a sudden, when it's all said and done, because you weren't able to execute, you're sitting on $1,000 loss. And now, instead of just having it as one trade, you've made one trade become two losing trades. And that's not what you want, because you can have, being that if you're a 60% percentage of profitable trades, you can go on a losing streak. You can go on several trades of losing streaks here and have that issue. And what I'm going to do is I have a document that I'm going to bring up and show you how that looks. Okay, so here's a spreadsheet, the expectancy formulator, and the calculations are based on Van Thorpe's theory on position sizing, which a lot of traders have talked about and you might have heard of because it's widely used. But for this sake, the capital that I put in here was a $10,000 account. The risk on capital is 5%, a winning percentage of 60%, and the win-to-loss ratio is 1-to-1. And what that means is pretty much 1 for 1. And you're risking 1 to make 1 pretty much. I don't have any commissions put in here, but the calculation on here, I'm not quite sure. This is taken over on 307 trades, but you could see here a $10,000 account with that much on these calculations. Now, this is not, what you can expect. These are just hypothetical. It's saying the final return here on 307 trades is 1.6 million on a $10,000 account. Now, when I look at that and hear it, I'm a little skeptical as well, but I just want you to see how the curve looks. And you could see how eventually it takes a little bit when you have a $10,000 account. It takes a little bit to really get some steam going. But once you break the 200,000 level, that is when you can really, really excessively increase your count. And if we look here, it's just taking all the trades that it's formulated here. And you could see the profit and loss, the peak gain, the drawdowns. So the drawdowns here are what's important. You get these little pullbacks here, which is part of trading. But you can see here that you have 4 losses in a row here, which 4 losses to somebody in a row could be a little shocking. But then this one is a couple winners in a row as well. You get win, loss, win, loss. You get 5 losses here, followed by 5 winners. So I don't know how accurate this is. I mean, I know that getting more losses in a row is more likely than getting, these kind of wins, but let's just say this is what we're following here. But you can see here that we can go on a streak of losses and wins and really increase the account, and how hard it actually is to take a $10,000 account and make it into an account that is much larger. On the this next slide here, I'm going to show you what the drawdown expectancy is. Okay, so on 50 trades, and if you have a winning percentage of 50%, which is 25 trades, 25 winning trades, you can go on a consecutive losing streak 6 times, and you can go on a consecutive winning streak six times. So if we scale down here, and we look at 50%, the probability of seeing this amount of consecutive losing trades within a 50 trade period is based on your winning percentage. So on 50%, it is very likely that we'll go 2 trades in a row for losses. It's very likely on a 50%. So we're looking at a coin flip that we go 3 trades, that we can go 4 trades, that we can go 5 trades, and that we can go 6 trades on a consecutive losing basis, and vice versa. We can go on 6 trades. So this is where a lot of traders kind of panic. They panic on the 3rd or 4th trade, and they don't take that same setup that they know that could potentially work out for them, or they go in a little bit heavy. So they go on 2 trades here, 3 trades, and they go on the 4th, and instead of risking 5%, they risk 10%. And then that 10%, all of a sudden, well, that right there is 5 trades in a row. And then the 6th one, now they're playing catch up here, and the 6th trade, they're worried about what they're wanting to do, so they're going, okay, I want to scale back now. And then they might go to 2% of risk, and then it actually might profit, but it's not profiting that the amount of the overall risk was taken on the other trades here. So, when you start tweaking and messing with the percent that you put at risk, that is when you start sabotaging your own efforts. That is when you start hurting your own trading unintentionally, because you're worried about drawdowns and you have this emotion inside of you of what is going on here. And then when you see a little bit of profits, it's not enough to really cover up the losses that were had occurred because you're not using the proper risk management, and this all boils down to execution. Okay, so you'll see here that I added another bullet point here for trading rules, and we'll come to that in a second. We've been talking about it, but let's go back to understanding the directional trade. So with that, those last two slides that I showed you, you can understand of how important it is to specifically focus in on a percentage and just continue to use that, and understanding when you journal and keep track of your trades of your winning percentage, your average drawdown, your average profit, which actually you would want the average drawdown to be less than your average profit to increase your account. And you could see how hard a $10,000 account is initially hard to get higher, but once you get to a certain level, then you can really enhance those trades, really enhance the portfolio or your account by getting to that certain limit. So it's really important understanding and just kind of pausing that slide and looking at that drawdown and saying, I didn't know that, because most people don't know that they can go on a consecutive losing streak, even though they have a winning profit or winning strategy, that they can still go down and have a losing streak of 2, 3, 4, 5 trades, which I've have have had in my own trading myself, of having those losing trades. It's really about just sitting back, focusing, and just initially just being able to execute. Option credit spreads, you're going to be risking a little bit more because the profit is a lot less than what your overall risk is on, but it's a probability trade. So the probability of that option expiring worthless, depending on which option you're selling or what you're doing, is very likely, depending on which option you chose. With that, you're going to have to risk more money. So the profit, so with the risk on a trade, on a directional trade, you have that premium that you've paid. That's the most you can lose, but at times, what a lot of traders will do is risk $3 to make a $1. And I will get traders oftentimes that I've coached or mentored or just email questions saying, well, option selling doesn't really make sense because you're risking $5 to make $1. But again, it's a probability trade that has a high success. And hedge funds, institution, large investors that are successful consistently utilize trading options or selling options to make large amounts of money. And when you get to a certain point in your portfolio, that is a strategy that most investors typically utilize. It's less maintenance. It's a widely utilized and kind of a scalable strategy where you can just sell those options and just focus in on where the market is at on the indices, and just kind of at times scale into a position. You can roll out of a position. So, there's a lot of dancing that somebody can do with a credit spread or credit spreads or credit trades where they're not as active in the market. When I look and explain this to you, a directional trader is more aggressive. They are an offensive player. They're looking for moves. They have to wait for it. They're sitting in front of the computer. They're on top of the move. Individuals that sell credit spreads are ones that are defensive minded. They are not in front of their computer all the time. They're not having to focus in on the market or trying to catch trades. They're just managing a position. They're more of a manager of trades. Anyways, let's go to execution here. Execution is very important. Execution is going to be dictated on your trading strategy and also on your own emotional capital. And what I mean by emotional capital is your happiness, your sadness, your aggressiveness, just your own personal attitude in how you live your life is going to dictate on how you are successful in trading. And you'll hear at times where traders will say, you need to keep your emotions in check. You need to be some kind of ice cold trader. The reality is that there is nobody on this world that is a human being that can control or that can erase their emotions. Emotions are part of our everyday decisions. Emotions are part of your life and in your thinking and mind for a certain reason. There's no way to eliminate the emotion that you have. There is a way to understand it better and to understand why those emotions that you have are dictating some of the decisions that you are making. And journaling is one of those ways that you can dictate and understand what is exactly going on with your own mind and these emotions that you have. So a lot of times, if there's a losing trade and you feel down, the fear of loss or the emotion that you have towards that loss might not be because you have a losing trade. It might be because of failure. It might be because of, in high school, your high school coach sat you down because you missed a three-pointer and that lost the game and you guys could have won the title. That could be what is the boiling point or what the issue is about your loss. As funny as it sounds, we all have issues and we all have to understand what is causing that. Execution is going to be based, your computer and your emotions are going to dictate your overall execution. The best way to focus in on execution is not to focus in on the money. The best way is to focus on the things that will help you make that money. So what I mean is, if you're not executing your stops, well, that you're sabotaging your own profits. And if you focus in on the money part of it and you're not fixing the fact of you're stopping out at your stops, well, you are going to start to you're going to start to press for profits, and you're going to get into a trade. Instead of taking the 2 to 3% that you typically do, you're going to take 10%. And then that's a losing trade that goes back into that whole diagram that I showed you of consecutive losses. And then now you're just continuing to snowball. And that snowball effect is going to eventually, the odds and the snowball effect are eventually going to catch up with you and really, hurt your trading. So really, when we look at the trading rules, focusing on your execution, it is very, very critical to your success. Understand why you're taking the trade. You have to understand the whole thesis that you have. It's silly, but this all goes into defining your risk. Why are you taking the trade? Why are you taking the trade? What do you see? What is the setup that you have? And this is all what journaling will do. It will force you to think. It will force you to vet your own deals. Because if you say, and you look at the next step here, and my suggestion is never get into a trade because somebody else is buying or selling. This is kind of the easy way that people like to do things. They say, well, because somebody on CNBC or somebody in the paper, or because this hedge fund guy, Warren Buffett, bought it. That has no dictation on your trade and what your thought process is. You have to boil it down, and you might get someone else's research. There's nothing wrong with utilizing someone else's research or time, which is something I emphasize on utilizing myself, but never just take the trade because I'm doing it. I want you to understand the reason why I'm doing it and my overall thought process behind it. Because my thought process might be different than yours. You could look at the same trade and say, well, I don't really agree with what Josh is saying here. And there's no problem with that. You could say, well, I kind of like what he's doing here, but I actually think I could do a better setup. And that's what I encourage, for you to think outside the box. Utilize me, help you find the idea, but then going in and figuring out what the best setup. This is something I do with option activity. I follow option activity, and I see insiders acting on stuff all the time. Sometimes they're right, sometimes they're wrong. But what do? I ask myself, what is the best trade for me? What can I do to help me get an edge, utilizing this information that I see with these buying and selling of options, and structure the trade that not only will benefit myself, but benefit my members that are part of the service, to give them the best opportunity to have a profitable trade, because they could be buying way out of the money calls, which is a very unlikely approach to success, buying out of the money calls. So what will I do? Well, I'll come down and I'll get into a call spread. I might not have the amount of upside that these traders will have buying long calls, but again, I don't know why they're buying these calls. All I know is that they're buying these calls, and they could be a couple different reasons why. They could be acting on some kind of information, and they could be wrong as well. But for me, I want to take that information, utilize it, kind of figure out the best opportunity for me to make profit, and then structure the trade that makes the most sense for me. So this is how I utilize the information that I receive and then making it my own trade. And that's something I suggest. Again, I want to emphasize, know how to exit your trade. It's silly, I know, but these are things that I want to imprint in your head. These are critical aspects to success. Knowing how to exit your trade. Where is the level that you're going to get out of? You can't react. There's times when you're playing options and you'll have something that gaps against you. You have to kind of be ahead of that curve. You have to understand that this has happened in the past and what is the worst case scenario. So, for me, depending on what stock it is, if I'm risking, if the trade is buying a call at $1 and I'm risking a full dollar and my plan is to stop at 50 cents, well, what I'll probably do is I'll actually just risk the whole 50 cents and I'll open up a call spread, because if it does gap lower and something happens on some kind of event or something that I'm not aware of, well, I've just risked the whole 50 cents, which was my stop, which at that point, that 50 cent stop that I had, I can typically dictate that I'm not risking the whole 50 cents. In theory, I am, but if it does come into that level, that spread might be worth 15, 20 cents, where I'm not risking that whole 50 cents, but I've risked that spread. And instead of risking the whole dollar, which if the prices do gap lower, it could go to 10 cents, in reality, I risked 90 cents instead of that dollar. By doing that, I'm kind of just planning these issues that might come in trading, which will come depending on how long you trade. When you take 300 trades, 400 trades, 500, you're going to have trades and issues with companies that you're not aware of or that you haven't seen, and you just have to be and learn from those mistakes and be ahead of it, because you don't want that to happen again. Never go in too big. Again, going back to what we covered in those slides, we can see why we don't want to go in too big. Even though you have the best hunch in the world, I see insiders all the time in the option market. I saw one in a company called Seven Mankind, or Seven. It was a Chinese company. Blatant insider buying. They're coming in for 1250 options, and they're buying them across the board. Blatant. I mean, option activity was 200 times the normal. They were coming in days ahead, and then they came in the next day and bought the 1250s. Just because you see and you might have some inside information, which is illegal to act on, but you might, and some of these insiders might have some information that they think might move the stock, but they're not traders and they don't know what they're doing sometimes. Well, the news came out that the company was going to get bought out, but the buyout price at that time was $12.70. They were paying 60 cents for these options, which I actually had followed them as well. And I lost. That was a losing trade. I was playing on the back of it. I was right. That there's a buyout coming. That's one of the things I predicted. But I was wrong on the trade, because the option was only worth 20 cents. That's a loss of 40 cents right there, because they went out of the money instead of going in the money and using options like that. So even though they were acting and the footprints were there, they were still wrong on that. So even though the best hunch in the world is the best hunch, you have to stay inside that sliding scale and that percentage per trade at risk. Never go in too big. If you go in 10% on a trade and you get hurt, especially on options are grenades. They quickly disintegrate. Stocks are a slow grind. Stocks have lots of extrinsic value. They don't expire unless the company goes bankrupt, but they are slow to eventually get somebody to blow up their account unless they go in too big. With options, it's fast. And that's where a lot of traders have issues with options, because they get into stocks and they have what they think is success. And the success is that the market's going higher. Everyone looks smart in a market that's moving higher. So they've gotten to these stocks, maybe 4 or 5, and they might have averaged in. Stock has gone against them, and they didn't go back to this one. They didn't define their risk in every trade. They didn't journal it. They didn't have a small percentage per trade. They weren't able to execute. They didn't understand why they were taking the trade. They didn't know when to stop or exit. So the trade goes against them. The stock pulls back, goes against them because the market's lower, or the market pulls back over a certain amount of time. They just sit there because they're not sure what to do. The market comes back, pushes higher, and their account goes from 10,000 to 15,000 over the course of, let's say, a year and a half. Well, they think they're stock traders. They think they're stock jocks now, and that they can take this success to the options market. Well, they didn't have these fundamental pieces to their trading. And when they go into options, they're buying out of the money options. They're going in too heavy. They don't understand the complexity of options, and they don't know when to get out of a trade, when to take profit. They don't have reasonable expectations. Bam. Their 15,000 account is now 2,000. I had a member that started out. It wasn't a member that was part of the service, but came to me after he blew out $40,000 of his account. Went from 45,000 to about 6,000, and comes to the service looking for help and a quick fix. And again, there's not a quick fix for that. I mean, you lose 40,000, you have to start over. You have to start from that 6,000, but there's damage that's done there, and there's very, very big issues that this individual had and still has that he needs to get over. You never want to go in too big. Trade to trade. And what I mean by this trade to trade is that sometimes you just have to put on a trade to trade. Your confidence might be low. You might not be feeling the best. But at the end of the day, when we look at the overall percentage of what a drawdown can be, and if you keep your percentage per trade that low risk amount, you trade small to trade and continue to trade in the game. Because that next trade could be the one that goes and takes you back and is that one profitable trade. That trade, it's a little bit of luck. Luck is part of it, and maybe not a little bit more than most what will teach you or tell you. In the beginning, I said luck. No, it's about skill, and luck has no part of it. And that's just kind of an arrogant and cocky thing that I once said, because luck is part of it. It's about utilizing these steps, having this strong foundation, and at the end of the day, being lucky. Mark Cuban made a ton of money in the market. And why? Because he got lucky. He got lucky, and he's not a successful trader. He's just somebody that has a little bit of money, or a lot of money, not a little bit of money, but a lot of money, but got lucky. Got into a stock in the .com, sold at the top, got lucky. Now he's the owner of the Mavericks, and he does have some investments. Part of it is just luck. Luck comes with execution and doing all those things to have and to help with luck. So if you do all those steps, you might become profitable, or you will become profitable. Luck might be the extra ingredient to be lucky and get that one huge trade or that buyout that you're thinking on going, or that could happen. It's all that, and it just comes with it. And trading to trade is that trade small, utilizing the small percentage and utilizing that percentage per trade. And even though when you're not feeling good and you're confident, journaling and asking yourself why I'm feeling this way will help with that and keep you trading and in the game. Have reasonable expectations. What I mean by this is not buying an option at 50 cents and thinking you're going to sell it for $4. Reasonable expectations are just about being consistent. And you have these expectations, you have to ask yourself, are these reasonable? Some people have unreasonable expectations. They say, I want to take my $10,000 account to a $100,000 account in 2 months. Is that unreasonable? Yes. Can it be done? Yeah. It's a very small percentage. I mean, I don't even know how much of a percentage that is. It has to be under 1. Can it be done? Yeah. But again, it's all luck there. Not utilizing any of these, it's just purely luck. And if it's 1% 1% chance that person has to be able to do that, taking a 10,000 to 100,000, well, they have a 99% chance of blowing up their account. So let me ask you, do you want the 99% chance of blowing up your account, or do you want the reasonable expectation of taking your account from $10,000 to $100,000 in, let's say, 2 years? That is more reasonable, and that's a better understanding. It's the same thing with options. Buying an option, buying it at 50 cents and saying that you want to sell it at $1.50, that's unreasonable, because there might be resistance on the underlying that won't allow you to sell that option at $1.50. You might get a 50% return on the option, which is good, but not looking at the overall underlying of the stock, seeing resistance or seeing where support is at, not looking and having these reasonable expectations will blow you up and will have you having profitable trades going into losses, and then having losses continue to go to losses and just continue to roll. You got to have reasonable expectations. One I'll throw in there: don't take a trade after back-to-back strong price moves. And what I mean is, when you get a stock that has gone higher, my green arrow is a candle. So we have one candle here, you get a decent stock move, and then the next day you get another stock move. Well, most traders, amateur traders, will see this and go, oh, it's time to buy. Well, we could have resistance right here, and the risk to reward now is very unfavorable. You have to wait for it to hit here, because it's probably going to back off and then come back down and look for an opportunity. This trade is missed. You just have to move on to the next trade. 2 days of straight price movement higher, the trade is over. You just have to find the new trade that sets up just like this that you can get part of, unless you back off and play it. So you have to wait for consolidation. The time where you say, okay, it's time to buy, is probably when the majority of the public is thinking the same thing, and the majority always loses. That's how trading works. So you have just to wait for your setup, and you have to be patient. Again, reasonable expectations. Respect support and resistance. This is what I'm talking about when playing options, understanding the underlying, and taking profits into these levels. You have to respect it. You have to have reasonable expectations. You can't say, okay, it's going to blow through it. You got to be understanding and just respect it. It's just respect. It's just like anything. You just have to respect it. So on the chart here, I'm going to back this out a little bit. And right here, I have a chart of Facebook. You see Facebook here. And what I'm just going to point out here is, notice how this was resistance. You know, this level right here is resistance, and we get a gap into it. Well, this black candle represents prices gapped up and came all the way back down here, and this is where they finished on the day, backed off. And what did they do for the next couple days? They backed off even more. So when we talk about that last rule, you know, consecutive down days, well, we got 1, 2, 3 candles here. Some people might have thought this is the time to short here. Well, then we get this candle here, and it comes all the way back. So then these individuals don't wait for the setup. They get caught on the wrong side. They got to buy back in, and then they see it here, and they're like, okay, it's time to buy. Well, what is this right here? This is support as well. And we get prices that back off. Now, we do break out higher, and waiting for that breakout confirmation is good. But again, you got to sell into strength here. When you sell into strength, notice that prices hit into this resistance and finished off the highs there. Then we get this day where the candle retraces all the way back here. Again, resistance again. And prices come back again to resistance. So again, resistance, resistance, support, support, resistance, resistance. You got to respect it. Those are the levels that you have to be able to identify and be able to play. Look for the setups and wait for the setup there. On this move here, I was actually looking. This is 2250. I actually had a short waiting and on a stock here setting this up, because I realized and I knew of how this resistance level was working and how strong of a move this is, that we are likely going to pause. And this was actually a very pretty profitable trade, just waiting for that setup and waiting for it. Again, it's not an all-out short because of what the price movement here was, meaning that we're going to get a strong move and it likely bounces and pauses a little bit, and then you see it come back again. So support resistance is very critical overall trading and being successful in the market. The best setups are the ones with low risk to reward and typically set up into support and resistance levels. So looking at this Apple chart here, when we look at this, and I'm going to focus in on the right of the chart here, we get a very, very strong decline here. Very strong. And we look at prices here, it's from 700 and goes all the way down to 500, this candle here. And I will walk you through a little on what I was looking at here. So, we get this movement here, we get a little bit of a bounce. That's a bear flag for those that follow patterns. And then we get this very sharp decline here. You get some consolidation, and then it breaks even lower. This is a very sharp decline, and the reason for this is that the overall market's pushing lower. Also, there's liquidation because as I'm taking this video and recording this video, we have issues coming into the fiscal cliff that's in January of 2013, which is in about a month and a half. Apple was a very invested stock with hedge funds, mutual funds, private investors, and the easiest way that they can, because they're so heavily invested and it's a very profitable trade for them, the easiest way they can raise capital is to sell stock. And it's typically stock in the best performing stock. Or it's typically in the raise money, they're selling stock in the best company that has performed the best for them. So anyways, we see this, it's a sharp decline, and it's just waiting for the setup here. We look at these levels, and you can see here I had a support level here, and we get a little bit of a bounce here, but there was really no indication of a good setup here. The best setup came right when we saw this, and this is something I teach in the training series, is that a red to green candle. So we have this 700 all the way to about 500, 200 points lost in about 6 to 8 weeks, which is a very sharp decline. And understanding that the market doesn't go straight up or straight down, and Apple being one of them, companies don't go straight up or straight down unless there is a buyout or some kind of fraudulent news, which is not part of Apple. You get these bounces. And the last time we saw this kind of bounce was when prices gapped into resistance, and then we saw this little bit of reversal here, which then reversed and hit highs. But again, resistance, and when we see this resistance here, what did prices do? They backed off. They backed off here, backed off, finally broke out, and then that was that. So when we look here and it wasn't able to hold that, that's just pure liquidation, and it's just purely something that you don't want to take part of. But looking for the opportunities and waiting for them can really pay off. I took a trade here. I was early by 1 day, but I structured 2 trades to benefit me, because one was a little bit early because the options expired the next day. But the other strategy I used was a calendar spread by selling the current week's options against the next week's options, because I was expecting there was going to be some kind of bounce. The market was oversold. We're coming into key levels. Also, we're coming into some key levels here on Apple. And we look here, support was last found here, and we're coming right back into it. You see that candle here. We have some support there as well. And we're looking at about 525 to 500. Again, support is not just a dollar. It's certain stocks is going to be a wider area, and this was a support level. And you could see how this candle just really went all the way down here, and then buyers came all the way back. And if there's a volume, there's a strong volume candle underneath here. Well, we got that. We got the setup, and I was looking for this one. I thought the setup was going to be off this 525, and we get a little bit of bounce. It didn't happen that way. I was a day early, and the trade that I put on, I had to close it down for a loss, but I then structured another trade after this formed. This is a daily time frame. This is a daily chart, so I'm watching the formation, this candle set up on the formation here, and then I got the setup here. We went into this 515 level. We're able to hold. We get a red to green day, and this is where I got aggressive. I had the sliding scale, and I got pretty aggressive here because I was really confident in my setup here. And it really paid off, because the next day, which was on a Monday, this stock went from 540 to 560. This was a very profitable day. But again, I waited for my setup, and I waited for the opportunity into support where the low risk to reward was. Again, looking at that 515, I'm only risking a little bit, and I have a lot of upside to here, because what's going to occur here is a lot of short covering. You get a very strong move lower, you come into support, you're going to get a little bit of a bounce. Eventually that bounce may fade lower, but for that moment, looking for that setup, the low risk to reward, at that time I was risking about $5 to make about 15. That is the risk to reward that we want. That's what you want to always kind of look for in any kind of opportunity, is risking $5 to make 15, or risking $1 to make $3, risking $1 to make $2. You never want to do one for one, even though some trading opportunities are going to be that. You want to get it as close to support or resistance to look for those easy opportunities to say to yourself and let yourself know, hey, look, this is either where I'm going to be wrong or right. I'm going to get in and get out. And this is where you can just keep your money on the sidelines and present it in opportunities that are going to profit quickly, and not have to worry about watching stocks or watching this handful of stocks or caring about Apple, because those that are invested in Apple here were feeling a lot of pain. A lot of pain and worrisome, trying to figure out and trying to listen to analysts and read about research reports and about the product line and all this and all that, seeing it decline here and trying to figure out something they can grasp onto to eventually see it. And what will happen here is that there was a little bit of bounce, and people are saying, oh, okay, now it's going to come back. Well, after looking at this, and who knows what will occur here, but my process and my thinking right here is that this is a bear flag forming, and it could continue to roll lower for the time being. So with that, again, the best setups for your trading system are going to be ones off of support and resistance, where the risk to reward is going to be for 1 for 2, 1 for 3, 1 for 4, those kind of setups. What I'll leave with this, and hopefully you're able to get a lot of information off of this, and listen to my voice, listen to the enthusiasm that I have, and be able to be open-minded and review this video. Stick to your rules. And when you stick to your rules, it's going to go back to execution. And rules are just obeying by what we've covered here. You can add a few different things. You could say to yourself, I'm not going to trade when I'm sick, or I'm not going to trade on Mondays, I'm not going to trade on Tuesdays. I mean, these are things you can track. You could look at and say, Tuesdays are not my best day. And maybe it's not your best day because your setup is not the best setup for those days for some reason. Maybe it's a pause. Maybe Mondays are not the best day because there's really, at times, the market opens a little bit flat and there's not much going on. So sticking to your rules, creating some basic rules, and not making it too complex. Keep it as simple as possible, and that should help you in your journey in becoming a better and more profitable trader. If you have any questions, feel free to let me know. I'm always here to help. After you subscribe to the channel below, make sure you head over to optionsizzle.com and download my free report on how I outline the process of finding options that are on the verge for explosive moves.